Hello, my name is Steve Rocco. I'm the Director of Taxable Fixed Income at Lord Abbett. I'm also the lead manager on our high yield strategies and our multi-sector bond strategy. We are focused on the outlook for fiscal policy, specifically the likelihood of the passage of a Phase 4 bill that will support both the consumer and the outlook for states and municipalities. We remain constructive on credit, and it's based on the following. One, we've seen both rapid and sizable policy support, both from the Fed and from fiscal authorities. We've also seen improvements as the economy gradually reopens with some fits and starts. We also think there will be therapeutic that would hopefully lower the mortality of the disease. While not a short-term call, we think longer term, the amount of shots on goal on the healthcare side will make it likely that there'll be either a vaccine or an antiviral that can help lower the mortality of COVID-19 and can further support the reopening of the economy. One of the key debates that we are having on our team is the outlook for growth as we reopen economies. There is one scenario where growth is slower, where reopenings are staggered. Yields continue to drop, real yields are negative, which would favor quality exposures. It would favor companies that are benefiting from the current environment, those companies being mostly in the technology and healthcare sectors. Or will there be a therapeutic, quicker, that's more, that has a higher degree of probability of success than the market's currently impounding? And if so, will that lead to a faster recovery? And if it's a faster recovery, you'll see a shift into down in quality exposures like triple C's and high yields or more cyclical sectors. You'd also see real yields rise as interest rates move higher and inflation expectations increase. I think the market is pricing in the former, not the latter. By the former, I mean kind of lower rates for longer, slower growth. That this virus and this crisis is going to continue on for longer than one would expect. Looking back a couple of months, I think people were more confident that there'd be a therapeutic in the fourth quarter. Our timelines have shifted into 2021, mid to late 2021. So therefore, you could see continued behavioral change. You can see regional kind of rolling outbreaks that slow down this recovery. And that would be mainly to the benefit of quality exposures. It would be a lower rate environment, and there will be a continued search for yield. So you'd see continued, I would say, financial repression as the Fed continues to pump money into the economy, as fiscal hopefully continues to bridge us to the other side until there is that therapeutic. But right now, I think the market is continuing to price in a scenario where COVID is with us for a while longer. The economic outlook is highly uncertain, which is leading investors to favor more quality exposures. So for example, we are looking for companies that have strong balance sheets, high cash levels, low leverage levels, versus companies that have weaker balance sheets and that are more dependent on a therapeutic or recovery in their business. I think the reality is spread levels have recovered substantially, right? There's still opportunities, but we have to pick our spots.